terms of foreign-wise, we have seen global yield curve steepening a lot lately, especially driven by the U.S. and a bit in Germany too. And the foreign part is understandable as, there's more fiscal concern, fiscal deterioration, and there's talk about, bond vigilantes are back in the market. To me, I think bond vigilantes is mainly, the fast money type of investors or more tactical style investors, even in the long only space, trying to make some money, trying to stir the rates higher and when they can go. But when it comes to domestically, Japan, the super long end is traditionally being dominated by Japanese lifers, insurance companies. And, I think there's a bit of supply and demand imbalances in that space just because of, Japanese lifers, they have lengthened or extended the duration to close that so-called duration gap. So interest rates, liability, asset and liability mismatch in the past 3 to 4 years, just because there's a new Solvency II regime in Japan that is being introduced this year.
Yeah, and I was actually reading about one of the biggest lifers in Japan having to basically close their positions because they're getting smoked. And perhaps this suggests that this is something structural rather than some technicalities that are happening and repositioning that are happening right now.
Again, going back to that, our earlier discussion, I think, 30-year bonds in Japan, JGBs trading above 3% is attractive for all these Japanese investors, long-term investors. The reason why they're not coming in and buying everything up is because they have lengthened their duration. And a lot of that, and unfortunately, they have bought all these bonds when it was trading at a lower yield, right? And yield has become a lot higher, so they're having a bit of unrealized losses on their balance sheet, and they cannot actually come and extend duration at a very fast pace. They are not as tactical too. And in terms of real money investors, we have seen foreign investors coming in Japan and buying up a bit in the super long end just because of it's actually pretty attractive if they hedge back to your home currency. For instance, US dollar and euro based investors, they're getting a pickup of around 150 basis points to more than 200 basis points based on their home currency versus their own, similar duration, 30-year US treasuries or bonds back home. And the reason they're not coming in is because there's a bit of volatility after, Liberation Day sell-off in the US, and also, there's continued steepening in the global curve. But again, this is in Japan, I think this is a bit of supply-demand imbalances. And there's already, I think, works being considered by because it's a technical thing. I think policy responses already under consideration. And we were talking about, a bit of tweak from Minister of Finance just because they are the one issuing the bonds. They can easily walk back and, try to tweak that issuance amount or, on the curve or BOJ. There's a QT, right, quantitative tightening in place. They can easily, tweak that. And recalibrate that whole purchasing style that they have, resembling a twist, right? Like what in the US in the Fed post-financial crisis.